Traditional and Roth IRAs get tested a lot on Part 1 because they look similar, but the tax timing is opposite. Traditional is usually deduct now, tax later. Roth is tax now, tax-free later. On the EA exam, they'll hide the key fact in one phrase like covered by a workplace plan or high income, and that flips the answer. Start with the traditional IRA. Contributions and earnings generally grow tax-deferred, and distributions are generally taxable. The big exam trap is deductibility. A traditional IRA contribution can be deductible as an adjustment to income, but that deduction can phase out when you or your spouse is covered by a workplace retirement plan and income is high enough. If it's not deductible, it becomes basis you must track. Now the Roth IRA. Roth contributions are after tax, so there's no deduction. The payoff is that qualified distributions are generally tax-free. Another favorite exam angle, eligibility. Income limits can block high earners from contributing directly to a Roth, but participation in an employer plan does not affect Roth contribution limits the way it affects traditional IRA deductibility. Here's a clean way to remember the employer plan rule. For traditional IRAs, workplace plan coverage matters because it can reduce or eliminate the deduction at higher incomes. For Roth IRAs, workplace plan coverage doesn't change your ability to contribute. On the EA exam, when you see covered by a 401k, your brain should immediately ask, are they testing traditional deductibility or Roth eligibility? Two more Roth rules are easy points. First, Roth IRAs have no required minimum distributions during the owner's lifetime. That's a huge difference from traditional IRAs. Second, Roth contributions can be made at any age, as long as you have compensation. And one more exam-friendly twist, even if income limits block Roth contributions, there's no income limit on converting a traditional IRA to a Roth. When a traditional IRA contribution is non-deductible, you're not stuck paying tax twice, but you must track basis. Basis is your after-tax money inside the traditional IRA, deductible contributions, and gets reduced as you recover that basis through distributions or conversions. On the EA exam, if you see non-deductible traditional IRA, think Form 8606 and basis recovery. Marisol has a traditional IRA, and she's also covered by a 401k at work. Because of that, she's made several non-deductible contributions to her IRA over the years. How does Marisol calculate the basis in her traditional IRA? The choices include no basis at all, adding distributions, adding all contributions, or subtracting distributions. Think about it. The correct answer is basis equals non-deductible contributions minus any distributions of non-deductible contributions. Basis is your unrecovered after-tax amount. Each time she takes a distribution or does a conversion, part of that basis gets used up, so the remaining basis goes down. A tempting wrong choice is adding distributions, but distributions are how basis gets recovered, not increased. Ethan turned 72 on July 30th, 2023. He's still employed full-time and has a Roth IRA. When must he start taking required minimum distributions from his Roth IRA account? The options range from specific dates to never. Think about it. The correct answer is never. Roth IRAs are not subject to required minimum distributions during the owner's lifetime. His age and the fact that he's still working don't change that for a Roth IRA. The date options are tempting because traditional IRAs do have RMD start rules, but that's the wrong account type here.